This is Value Investing Part 4. I'm going to try to wind it up with Part 4 and 5 and give you a few further specific suggestions. I think I mentioned Nexen, an energy company with very substantial oil holdings in XY, a Canadian company. Suggest ANR, the symbol ANR, American Natural Resources, a coal company, and Peabody Coal, an international coal company. These companies have substantial free cash flow. At least that's what I'm getting from their quarterly reports. And coal is something that is going to be used for many decades and will be in short supply, and the cost, as it becomes more difficult to extract, will go up. I suspect the profits will go up also. If you've seen my previous videos, the ones I put up in early '09 and mid '08 on value investing, if you just work out the recommendations I gave, had you traded alongside of me, and I could only put these up when I had somebody knowledgeable to do it. I don't know how to upload anything. So, had you traded along as best just by following that, you would be up 80% in 2.5 years. Which you may be up by more than that, but somehow I doubt it. I had 2 other videos which are relevant to today, which if you want to see ideas that I had before I developed them here to see if they worked. Bailout bullshit, in which I gave the arguments, my personal arguments, against TARP, and Bernanke Blues, in which I suggested that Bernanke was quite bold and that basically monetary policy, his monetary policy, would fail to support a recovery. And that appears to be true. And I'm on record, and you can check the video. Let me give you a couple of definitions. One is capital. Capital is not money. Capital is a tool, something that amplifies human skills, human endeavors. The use of the idea of capital as money is something that came out of financial obsessions. Capital is valuable because it enables people to create things that improve their lives that couldn't be created otherwise, and involves some use of intellect and a willingness to forego consumption temporarily to use resources and efforts to create technology, machinery, and also intellectual capital. Inflation is operationally defined for purposes of the markets as numbers put out by Goldman Sachs or by the U.S. government. This is crap. Inflation is a vague concept. The numbers that are applied to it is just a way that people on Wall Street can gamble. If you want to know what inflation rate you face, then look at what you personally consume. I consume rotisserie chickens. I consume roast chickens purchased, already cooked at Sam's and at Randall's. And those things haven't moved in 3 years. Plus, if you buy it at Randall's, at least for a couple of weeks, they gave you a gallon of tea free. Either sweetened with sugar or sweetened with artificial flavoring. Electricity. Well, I think electricity has gone up a little bit. But basically, at least in my area, it moves with the price of natural gas. And natural gas is lower in price today than it was 3 years ago. What has gone up is the things that rich people buy. The cost of having your dog's toenails clipped. The cost of dog grooming and boarding your dog for the weekend while you head for Vegas or for Macau or wherever the fuck you go. These are the kinds of things that people are paying more for. So I wouldn't confuse that with inflation. I personally am not sympathetic to Bernanke's what is called QE2, Quantitative Easing 2. Seems to me this is just another attempt by an established political force to pump up asset values for well-to-do people. Presumably, it motivates them to spend more out of current income. But I think this is kind of ridiculous. What it is not doing is creating inflation. This is Wall Street bullshit. What happens is, before the first action under Quantitative Easing 2 took place, financial speculators were front-running the Fed, bidding up paper assets. Didn't create any more demand for sugar, didn't create any more demand for coal, didn't create any more demand for oil. My understanding from CNBC is that the U.S. has oil up the ass. That we have oil overflowing its storage. It's the futures market that bids it up, and this is simply the sentiment of speculators. So, when you hear that the Fed wants to produce 2% inflation, what that means is they don't want the price of your rotisserie chicken to go up. That's not the whole idea. What they want to do is basically produce slightly higher wages and slightly higher prices so that people will have slightly higher incomes and will be able to service their mortgage debt. Because mortgage interest rates include an inflation premium. So if you have a 6% note or a 5% note, 2 or 3% of that was to cover inflation. And if your wages are not going up and prices are not going up, including the wages you get, then you're paying 5% real, not 2% plus 3% that represents the inflationary increase in wages that you got. It's to keep people from defaulting. It's not going to work. They're not going to be able to produce what they want. But the unsophisticated arguments should be ignored. Now, let's go into GDP. And this is why, how much time do you think I got?
Got 5 minutes.
5 minutes, okay.
A little less.
What we have in the United States is a notion that you get GDP up, that raising GDP, this is economic growth. So let me suggest, if you increase the sales of cigarettes, then you will get higher profit income for tobacco companies and for stores that distribute cigarettes, that sell cigarettes. And you will get higher incidences of cancer. Now, the conventional wisdom is cancer keeps people from working and therefore reduces GDP, so if people are healthier, they'll be able to work more. But of course, if you get cancer, then you're a wonderful revenue producer for cancer treatment. And cancer treatment is very, very profitable. And this is true of diabetes. Is going to be the boom. I mean, we've got an onslaught of diabetes and obesity. That's going to raise GDP. Because treating cancer, treating diabetes, and treating heart disease, that's big money, and that goes into GDP. The medical sector will go up. So, that's the end of part 4.